Hello investor, today hopefully you are having a wonderful time, and today I'm going to cover the company called Alibaba. The ticker name is Baba. Myself Pramod Kumar, I am a CFA charter holder and FRM certified. Okay, so this is the Alibaba financial year 2020 annual report, and if I'll go to this report, honestly this is huge. Let me show it to you. This is their as you can see, I am on the Alibaba's group holding NYSE Baba, and this is their 2020 annual report, and this is huge, right? In this one they have everything, all the risk factors, and also I did quite a video ago on a few months ago on Alibaba where I have gone into this the last year annual report, and it's quite deep as well. One thing to stand out here is the first 40 pages they just describe on their business profile, right? If you first they Jack Ma, and then if I continue, that's their overall economy, right? That's what they mentioned, that year-over-year growth is from their commerce revenues 35%, cloud is growing 62%, and their UQ average. So it's just not from the US perspective or North America perspective. We think Alibaba is just the company similar to like Amazon, which what is doing, but it's pretty much bigger than what they're trying to achieve. That's what it's highlighting here, and from what I found from their reading from their annual statement is the digital economy, right? So they are more into it, not just Alibaba website, right? Because that's only cover their 1/3 of the business if I won't include the cloud and UQ annual subscribers, right? So I'll skip this one, but I just want to show that if I continue from this this page, it's keep going and going. So it's a lot to read, and this slide I have also there, and let's get started, right? So so that's it. But what's the reason? The reason is not that. The reason is recently Chinese government, and I found this article that the Chinese government basically they have this one, the new antitrust rule targeting top internet companies, right? So they are doing some monopolistic practices like price discrimination, preferential treatment for the online merchant, and it says it affects these three companies, right? This Chinese company. Baidu, we already know this is similar to it's like a Google of China. Is Alibaba is the we can say is Amazon, right, of China. I didn't see the price effect on this one too much, or on the Tencent, but on the Alibaba I do see the price drops. So this is from the Yahoo chart, and if you can see, this price is dropped. It was here before, right, and then it's dropped significantly to right now it's trading at $260 US dollars and 63 cents as per November 13. So it's quite a significant amount of a drop, and before that. But one thing to note here, when I see this, and this is, you can see on the monthly interval, right, whether is it like a real drop? For sure this drop from based on the news, but as a value investor, we should know whether this is still a fair value to jump in. Maybe the stock is overvalued, right, at that time. Because why? Because here you see, as just on a month the price goes very sharp increase in the price, right, from here, right? Just from the drop here in 2020, and you can see the price jumps a lot. Maybe it's trying to recover, but how far it can go. But now the question is, okay, what is the fair value of the stock? So I will show the fair value of stock using the intrinsic value, and also try to also show the 2030 price, right? So I'll cover the today price, what is the fair price, then what is the 2030 price after 10 years of this stock, and then I will try to project with a different number. If you enter maybe on 260 or 280, then what is our estimated return, right, or IR, or our IRR return based on the free cash model. But before we do that, let's go quickly into see how's their margin, is how the company is doing, right, is the gross profit and all. So that's how the model goes. And feel free to give a thumbs up if you like this video, and I do request to please give a thumbs up on that. So I'll keep myself on hide so I won't cut by mistake anything. Okay, so this one, as you can see, I have taken from their 20K. So again, to re-emphasize the point that this is not just it is the ecosystem, right? And recently, the Ant Group tried to go, which is their payment and financial services, which should be the largest, the IPO, but it didn't go through, right? It has some problem and the last minute come out, but still they have a cloud. Okay, so let's go into the deeper, because the main one. Okay, if I go to the earning per share, right, on the quarter from the Q4 2019 all the way to Q3 21, which is coming, right? So this is what analyst is expecting that. So pretty much on the fourth quarter, which is coming now, they expect an increase in Q4, but then it's a dip and then it's pretty much plateau. So, but one thing so that's good that we have next quarter is increased because of maybe the holiday or seasonality. But one thing, because we also see the last quarter on the Q4 of 2019, it was higher than for sure their January quarter. So, but if I see from 2020 to 2021, their estimation, analyst estimation, is way higher. And also, what if I see from the past 4 quarter, their reported earning, which this is the actual earning, right, in the blue. So this is the actual. This is the actual earning, which is always higher, except from Q3, which is, we know, because of the COVID situation and all, right? So let's see. Next. So now, if in terms of the revenue diversification, that's what I want to show here, right? Diversification. Their main core business is, so this is in that's increase, right? This is in Chinese ruble, and this is the cloud business is also increasing, and all other businesses are increasing, even in their digital and innovation. That's very good to know, especially if you want to invest in you see the 62% year-over-year growth in the cloud business, and then 35% year-over-year in e-commerce business, right? So that's very good. So if you want to invest in the Chinese cloud market, so I think that's not bad, right? Alibaba is also good there. Okay, so overall, what we find so far is pretty good. Let's go into the more deeper, right? Okay, so if I see from here, maybe I'll do a little bit. Okay, so this is what this is in 1,000, right? So this is in US dollars, but this is actually, these are the ratio, annual ratio. And what is this? This is the liquidity of the company. So basically, we can see easily everything is over 100%. So this means on the short term perspective, right? If the market crash or maybe the COVID situation comes again, they don't have any problem. So they have enough over 100%, or in actually it's almost 200% coverage in terms of short term expenses, right? And from the cash, even is almost 60% more, right, in terms of coverage. And this is not just for as per reported in this annual statement, but it's pretty consistent if you can see over the last few years comparison. Okay, this is also very good. This is from their income statement, in short, IS. So if I see from the gross profit margin, and gross profit, the revenue minus the cost of goods sales, that comes as the gross profit, and then you take the margin. If you don't know how to compute these margin, I have a separate video in my channel, free to check it out. One thing to know here that the gross profit margin is, if I compare from 2017, and this is my latest, right? So this is the latest, it's decline, right? It's decline. So you see this is decline as compared to, for sure, 62%, but it's still consistent from 2019. Operating margin, and then if I see the profit margin is increased by 1%. Okay, so this brings the efficiency of scale, right? That okay, although the gross profit is lower, way lower, but still the bottom line is increased, right? Maybe, right? So that's good as well. So after tax return of equity is also is increasing, as you can say here, is 20%. Okay, so that's good here as well. So we'll see this from the other angle as well. Before I go into deeper, we need to see as a value investor from the all different dimensions. Okay, so this is again in terms of the dollar terms, what we have seen before. So you can pause the video to check. But one thing to highlight here is look at the research, right? If I see the research, it's increased, right? So it was like 2.4, and this is like 6 million, right? So that's very good. I think these are in millions, so this must be in $1 billion. So this is pretty good. And this is their net income, which for sure it's 3 times already increased as compared to 2020. So it's already, right, 6 was 6.3 and this is 21. So 3x already increase. So that's very good. One thing to also note there that if you have noticed that net income to the common shareholder is this one, but maybe I'll cover this in a separate slide, so I'll just keep the suspense. Okay, now I'll just show some of the graph. Basically we have covered up, so we are on here, and then I'll quickly show you some of the important point. If you see from their revenue and net income comparison, so this blue is their revenue, so very good, revenue is increasing, and the net income is not bad as well, so it's increasing. But if you see from the gross profit margin, as we can see from the earlier slide, earlier we only see from here, but if from 2015 it's a sharp decline, right? So it was before, it was like over 70%. So every year the gross profit margins are reducing, which is not great, right? So which is not great. And the revenue growth is also declining from somewhere around mid of 2018. So this was their peak period, right? So it's going like here. So this is, I don't like this one and I don't like this one. Let me know what you think so far. And so far, if you like the video, please subscribe to the channel. If you're new, I always forget to ask, and if please like the video, so more and more people will get benefit out of it. And this is one of the important thing I have found. As you can see, the number of outstanding share is increasing. If you see from 14 to 20, right? This mean, what does this mean, right? So this means that if you have the more people sharing the same amount of a dollar, so if the number of shares increasing, this means the overall the ownership of the company, what we got the price is decreasing. So they dilute the company, which is not very good, right? This is the dilution part. The next thing is now, before we go to the spreadsheet, this is the last slide. As again, this shows the return on investment capital is only 8.5%, and the return on equity right now is 15.4%, right? So this means the one of the reason maybe because of maybe the return is doing good. We know, as we can see, their net income is up, but their equity is increasing, right? So that's why the return of equity overall is decreasing. They are diluting more and more share. If they go and purchase this up as well, right? If this purchase this up and then this will be down, then this will spike up again. So that's quite a little bit of math there. Okay, so let me go to the spreadsheet, and then I'll show you how I have computed the intrinsic value and 2030 value of the company, and to see whether this is below or higher than from what is the market price. Okay, so now you have seen the free cash flow model for the BABA, and here, just like in other stock valuation video where I have also used the EV model and the net profit model, I'm not going to use that model. I think the free cash flow is pretty conservative and giving me the good, and also the stock price is pretty much down as well. We just want to see whether it's still under or over, so I have used the free cash flow model, and that's let's get started. So I have used the free so this is the BABA, this is the current price right now in the market, and this is the free growth rate. So this is the free cash flow growth rate for the last 3-year CAGR, right? So that's what I have used here. So it comes around 28%, and then I assume after 10 years the company and I am also decreasing the growth rate very significantly, not right, as you can see, and then drop it to 2030 to 10%, right? So it's so maybe if I right, so it goes to 10%, right? You can see year over year I am reducing the growth rate. So let me show it to you. So from maybe this minus this is 2%, so pretty much 2% I am dropping. I just use the interpolation, so to drop, so 2% I am dropping every year, which is a pretty significant drop, and as you can see, right, so it covers pretty much the share dilution or more conservative scenarios, right? And next thing I know that, okay, in the company's balance sheet, so these are all in $1 billion, right? The total debt is 19.8 billion, total cash is 53.33, right? And then the 2.71 is the share outstanding. I have sold the company of 14 times of its 10-year annual sales. So that's what so pretty much then I have take this free cash flow and then grow by this growth rate, and then sell after 10 years of this 14 times. Okay, why 14 times? 14 times is usually suggested by is a good matrix from so by the value investor, so Mr. Pabrai. When I have read this book, and if you have seen one of my Mr. Pabrai's book reviews, that time I have mentioned as that as well. There are a couple of other methods, but I think this is good. So if I do all the math and divide the so this is my market cap coming, right? So in right now in 30 year, right? So the price of the stocks, if I discount the whole cash flow, and then discount it with the 2.7 billion shares, the price what I'm getting is $363.81, right? And if I take without the present value on the future side, the price is $613.71. 71 cents, right? Here I have also taken the right, so this is my price coming, right? So that's the price. Now we know the price in the market is fairly less than what we have right now. So what we think? Do we think it's still a good price? So that's why I have used the model again to come up with the intrinsic value, right? So let me go back to the slide. So this is the So this is the price. So right now, based on my future price of 600 something, right? So if I go to the buy the share at this price, my estimated return is 14.55%, right? But if I share price further drops, like let's say $240 or 180, right, which is pretty much 50% of my intrinsic value, that time is close to 20%, right, return I can able to get. This means more return. So, or if I just wait and the price bounce back, let's say if I enter in 270, then I'm pretty much getting almost same as 14.07%. So my understanding is maybe we should wait a little bit. You never know, maybe market crash or something happen and the price drop. But if somebody wants to go and have the capture in the Chinese market, this is not a bad stock. This is a good stock, and with the current price, even on the current price. But yeah, so even if the share bounce back, but if the share goes down, the price is $240, and we'll get a little bit more basis points there. All right. So, but if you think you are comfortable, you can go there. And this is only if you want to exposure in the Chinese market, right? But this is the international company and get a good exposure. So yeah, so if what do you think about it? Do you want to go and buy this stock, or what? Like, feel free to put a comment there. And please do like this video, give a early thumbs up, so more and more, and subscribe if you're new to the channel, and feel free to check it out some other video. And if you want me to cover any other stock which you want, or if you think the market will drops, and some of the tickers or stocks which you think is your favorite, and you want to see whether this is if I have not covered in my video, and whether this is what should be the good entry price as a value investors, why not just put in the comments, so I'll put in my list to make a video on that. Okay, so thank you for watching, and see you soon in next video. Bye for now.